What happens if a big name like Schwab, Fidelity, or Vanguard goes bankrupt? I know it sounds extreme, but it's not impossible. Think back to March of 2023. Silicon Valley Bank and Signature Bank collapsed. That year alone, 5 banks failed. And during the 2008 crisis, some of the major brokerage firms went under too. Lehman Brothers filed the largest bankruptcy in U.S. history. Bear Stearns collapsed. Even MF Global declared bankruptcy in 2011, the 8th largest at the time. So yeah, it's a fair question. If your brokerage fails, could you lose your investments? So in this video, I'll talk about what protections are actually in place to protect your assets. First, here's a quick rundown of how these firms are owned. Schwab is a publicly traded company on the New York Stock Exchange. It's owned by its shareholders, and its largest shareholders are mostly big institutions like mutual funds and pension plans. It's managed by a board and has an executive team. Fidelity is privately owned. It was started by the Johnson family and is still family controlled. It's not on the stock market and doesn't answer to public shareholders. Vanguard is very unique. It's actually owned by the investors in its funds. So if you own a Vanguard mutual fund or ETF, you indirectly own a piece of Vanguard. There are no outside shareholders, and it operates at cost to keep fees low. But like the others, it still has a management team and a board that oversees operations. Now, no matter who owns these companies, all major brokerage firms are heavily regulated and audited on a regular basis. I'll touch on more of that in a bit. First, it's important to understand how these brokerages differ from banks. When you put money into a bank, like a savings account, CD, or money market, the bank actually owns that money. You're basically lending it to them. They in turn use it to issue loans or make their own investments. That's called fractional reserve banking. Your cash isn't just sitting there. The bank keeps some of it on hand for withdrawals, but the rest is out in the world being used. What you get in return is a promise that they'll pay you back on demand. If the bank is FDIC insured, your money is protected up to $250,000 per depositor per ownership category. But what about anything over that limit? Anything over $250K could be at risk if the bank fails. Each category gets the $250,000 of insurance. Let's say you got $250,000 split between a savings account, CDs, and a checking account. That all counts as one ownership category under FDIC rules. Now, if you also have another $250,000 in a qualified retirement account like an IRA, that's a separate category. Both would be insured up to the $250,000. Now, with joint accounts, each owner gets the $250,000 worth of coverage. So if 2 people co-own a joint account, that's up to $500,000 in total FDIC protection. If a bank fails because of bad loans or poor investments, the FDIC steps in. They'll either reimburse depositors or transfer the accounts to another bank. But there's no guarantees for anything over the insured limit. That could still be lost or partially recovered. Now, brokerages work differently. If you own stocks, mutual funds, or ETFs, those investments are held in your name. You remain the sole owner. The firm does not own them and does not use your money to trade for profit. Your assets are legally separated from the brokerage's own finances and held in a custodial account separate from the brokerage's assets. So even if Schwab, Fidelity, or Vanguard were to go under, your investments would still be there. Your investments remain intact. They'd usually just get transferred to another firm. And importantly, they can't be used to cover any of the company's debts. Let me take a quick moment here to say I'd sure appreciate it if you hit the like button, maybe leave some comments below. It does help the algorithm and I'd sure appreciate it, so thank you. Now, for things like Schwab's ETFs or Fidelity's mutual funds, those are separate legal entities too. So even if the parent company fails, your money in those funds is still protected. This doesn't mean that there's zero risk. If a brokerage fails and the client's assets are lost due to some type of internal fraud, theft, or mishandling, that's where the SIPC insurance comes in. SIPC covers up to $500,000 per customer, including up to $250,000 in cash. And here's the key. That coverage applies to each legal account type, or what's called the capacity. So if you have an individual account, a joint account, an IRA, a trust, and a custodial account for a child, each one gets its own $500,000 of SIPC protection. But remember, SIPC doesn't cover losses in the market if you make bad investments and they go down in value. It also doesn't protect things like commodity futures, cryptocurrencies, private placements, annuities, or other insurance products. In addition to the SIPC insurance, most large brokerage firms, like these three, offer their own additional insurance. For example, right on Schwab's website, they state that they work with Lloyd's of London to offer up to a total of $600 million of additional insurance, limited to $150 million per customer. Of course, Schwab has over $10 trillion in total client assets. So $600 million is just a small fraction of the total, but it would certainly help cover any fraud associated with multiple individuals if the SIPC insurance hit its limits. Fidelity also provides additional insurance above the SIPC limits, and from their website, we can see that they purchase an additional $1 billion in total excess coverage. Again, a small percentage of the total of $15 trillion in total clients' assets. Vanguard too states that they carry additional coverage, but it's a bit vague about the exact amount. Of course, SIPC is there only if your brokerage fails and your investments are missing due to fraud, theft, or serious misconduct, and not from any market losses due to investments decreasing in value. So who makes sure these firms follow the rules? Well, the SEC is one of the primary regulators of the securities industry. It oversees disclosures, financial reporting, and fund structures. If a firm misleads clients or mismanages funds, the SEC can investigate, issue fines, and even shut them down. Then there's FINRA, a self-regulatory organization authorized by Congress. FINRA conducts routine audits and exams, licenses advisors, and enforces rules of conduct. Major firms like Schwab, Fidelity, and Vanguard also have internal compliance departments that actively monitor their operations to prevent violations before regulators even need to step in. In addition, they are required to file regular financial statements, fund disclosures, and client asset holdings. These firms also undergo independent third-party audits to verify the accuracy and segregation of client assets. So there's actually quite a few layers of protection in place. First of all, your assets are held in a custodial account, which is completely and legally separate from the brokerage's own balance sheet. That means that even if the brokerage were to go under, they legally cannot touch your assets to cover any of their own debts. On top of that, there are multiple regulatory agencies keeping an eye on things to make sure these rules are being followed. And if something like an internal fraud were to happen, then there's also the SIPC insurance to cover any of those lost funds. Now, to be clear, nobody can say that there is zero risk, no matter where you keep your money at. But if you're with one of these major reputable brokerages, your assets are about as safe as they can be. I hope that clears up a few things. Let me know what you think of the video below. Thank you for watching.